Goldman Sachs and JP Morgan are among the banks whose strategy teams are signaling alarm bells on U.S. equities. We'll discuss that and the biggest equity, which will be reporting earnings soon, today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. The Shiller CAPE Index, or Cyclically Adjusted Price-to-Earnings Ratio, is a metric used to evaluate whether the stock market, or individual sectors or indices, are overvalued or undervalued compared to historical averages. It was developed by economist Robert Shiller, the Sterling Professor of Economics at Yale, and is also known as the Shiller PE ratio. Here's how the CAPE ratio works, and I think I actually have a chart which I can show at the same time. So you can look at this as we think about what it is I'm going to be describing here. So I'm going to try to take a look and see how clearly you can see this chart. This chart, present day, is right here, this red dot over on the right. If you're having a hard time reading that number, that's 37.35. This data, which I had to pull actually from a website that tracks these things because my Bloomberg data does not go back as far as this does. This supposedly goes back to about 1870. So we are looking at more than 150 years worth of historical data. And here's how this CAPE ratio works. So much like the PE ratio, price, it uses the current price of the stock market index, such as in this case the S&P 500. Earnings, rather than what we more commonly refer to, which is either the consensus forward estimate, which is the forward PE ratio, or the trailing 12 months or last year's earnings, it actually takes an average of 10 years of earnings, and they actually also inflation adjust that number. This 10-year period smooths out short-term fluctuations in earnings caused by business cycles. And this is theoretically giving a more stable view of valuation. And creating a time series like this permits us to compare the valuation of equities right now to how this has looked in the past. So again, what is this? This is simply a smoothing mechanism where rather than taking a look only at next year's earnings or only at last year's earnings or the last 12-month earnings, you're taking a look at 10 years worth of earnings. The theory being that you are smoothing out business cycles. Now, a couple of things to note as we take a look at this chart. The first is that if we take a look at this 150 plus year history, it's fairly clear that we are above average. And in fact, we can see that, other than this, if we'll include 2021 as a part of the current market cycle, which I think it would be reasonable to do, so basically the post-pandemic era, there was only one period in this 150 plus year history where the CAPE ratio was higher. And that was the tech bubble in the late 90s and into 2000. And you can see actually that this number is significantly higher even than it was in 1929, before that market crash. Okay, so that's the backdrop that these analysts are looking at. In a nutshell. It's a little bit more complicated than that, of course. So the numbers that we're looking at are 3% is the return that Goldman Sachs is forecasting per year over the course of the next 10 years. And JP Morgan is forecasting 6%. These are both considerably less than the average returns that equities have returned more recently, which is closer to, we'll call it 13%. Depends how far back you go. But that's what we're looking at. So what does that mean? Well, if we were looking only at price for the S&P and not dividends as well, that would mean that 10 years hence, the S&P would be about 7,900 by Goldman Sachs' work, and about 10,500 by JP Morgan's work. Now, I want to make a quick point about these types of forecasts because they grab headlines. Those of you who may have decided to tune in or are listening intently because Goldman Sachs is saying that the S&P is going to return 10% less a year on average in terms of total returns than it has recently, are probably paying fairly close attention to that. I want to make just one quick point just about street behavior when it comes to strategists and analysts. And I'm not, accusing any bank of anything here, but if you're going to be bullish as an analyst or a strategist and set a price target, set the highest one. And if you're going to be bearish, set the lowest one. It's just going to grab more eyeballs. It's going to get more attention. If CNBC or Bloomberg or any news organization is going to pick up on what you're doing, they're much more likely to do it if you are at the extreme. And we see that often enough. Somebody sets a $10,000 price target for a stock, and suddenly everybody wants to talk to them and say, well, how do you get there? I think that this is true probably for more often than not for exceptional price targets on the highest flying stocks. So for people who are calling these eye-watering numbers, and whether it's Tesla or Nvidia or AMD or whatever, that's how you get attention. Because of course, forecasting over a 10-year period with any real accuracy is a challenge. Let's talk a little bit about, and actually I should probably pull that chart back up. Let me see if I can do that. I have to get it here. I'm just gonna go like this. It's on a PowerPoint thing. I just done a grab so you can see it. Let's think a little bit about the things that drive what's in the CAPE ratio to begin with. And that is that if you have any really exceptional periods in there, that can throw things. And so when we look back over, say, the last 10 years or so, did we have any really material pullbacks? Well, of course we did. We had the pandemic. And, what's rather interesting to me, actually, is that we see how low the CAPE ratio got in the great financial crisis. And that was even net of a huge drawdown in earnings for publicly traded equities. I'm going to pull up the S&P's earnings just so that we can kind of think about that. Let's see, I have the adjusted, let me see if I can get some earnings per share. There we go. Okay, so I'm just going to pull my Bloomberg screen in here. This is just to illustrate. I'm going to get rid of some noise in here as well. And let's just maximize that. Okay, and let me just give this a little bit more. I'm going to highlight it. That'll brighten it up a bit. Okay, so one of the things that happens, of course, is that if you have a huge pullback in earnings, and we did have one within the last 10 years, we had the one during the pandemic, as you can see, is that those really big drawdowns are going to have an outsized effect. That's not normal business cycle kind of stuff, right? So I don't think we can, so as big as the number is right now at 37.5 times, let's just call it 37.5 times for the Shiller CAPE index. As big a number as that is, bear in mind that that has to incorporate something highly unusual. And we had two highly unusual big drawdowns within the course of the last 20 years. The great financial crisis was a setback to overall corporate earnings, largely because financials were actually losing tremendous amounts of money. That was quite unusual. We don't get that kind of thing very often, and you can kind of see that if you look at this chart. And actually, if I knew how to quickly turn this to a logarithmic chart, this would be easier to illustrate, but I can do it this way instead. And I'm just going to show you how much earnings fell for the S&P during these really remarkable drawdowns that we had. Okay, so we had a nearly 60% drawdown in corporate earnings during the Great Financial Crisis. That's not to say that the average company fell that much. It's just that you had an economic slowdown that affected many businesses, and then you had a credit crisis that severely impacted a relative handful of businesses, but that ended up dragging the earnings for the overall index down significantly because you had a bunch of companies whose earnings were negative. And similarly, during the pandemic, you had that kind of a situation. And when you think about companies having negative earnings and the impact of that, just think about really capital-intensive businesses whose revenues went straight to zero. And maybe a good example of something like that would be a company like Carnival Cruise Lines or Royal Caribbean. Businesses that have billions of dollars of depreciating equipment that are simply not in use. So revenues literally go to zero. The ships aren't sailing. And you begin to get a sense of it. Nevertheless, so I'm going to mute a little bit what this CAPE ratio is saying because it incorporates, these recent ones here, incorporate a couple really low earnings that dragged it down. So you can imagine that if you have a 50% drawdown in earnings in a single year, and you're inflation adjusting these numbers anyway, then that means that's a 5% swing on a trend line over a 10-year period, if we can think about it like that, right? So that by itself accounts for, at a minimum, a turn or two against the average. And so it would be reasonable to take something like that out. Okay, so let's assume that we do take something like that out. Where does that get us? Well, maybe it gets us back to valuations approximately. So if you're looking at my screen right now and you can see this, then basically where are we if we kind of say those were really unusual events? We're not forecasting that. We're just simply forecasting slower rates of growth and slower rates of price appreciation because we already have relatively high price appreciation. That would get us to a number adjusting for those factors that is at or slightly higher than the cyclically adjusted PE ratio that publicly traded markets had right before the crash in 1929. Because if you don't adjust for those factors, we're actually higher than that now. And as a reminder, in 2000, the NASDAQ fell, 80% or so. So I'm not trying to say, look, we're staring down the barrel of a market crash, but let's just say that that we're more vulnerable to it. But I want to offer this as another way to think about what Goldman and JP Morgan are saying then. You can take their longer-term price targets, which would be, and again, I think Goldman Sachs, if you said, okay, their 10-year forecast for the S&P is 78, 7,900 or something like that, and I'm guessing that they're trying to pick the lowest number. If you're going to be bearish, you might as well be the most bearish. That still represents, an increase over where we are right now. And you could say to yourself, all right, well, what if from the current level of the S&P, call it 5850, we had a market correction, a drop of 10%, or a bear market, a drop of at least 20%. What would those returns look like then? Let's just say for the sake of argument that the S&P fell 20% next year, then you would be looking from that point forward at a 3,000 point increase in the S&P on a price level basis over the course of the 9 years that followed. And that would be, round numbers, we'll call it a 70% return. So that just on a price level basis, plus the dividend yield would be a little bit higher, of course, if you've got a 20%. So the dividend yield on the S&P right now is, let's just take a look at today's numbers. I mean, if you're looking at something like SPY, call it 1.2%. So, you'd be looking at, 1.3, 1.4%. So if you think about the total returns, if we do get a correction or a bear market, really what they're saying is if you get some kind of a reversion to more of a mean historical multiple, that the growth rate from there could be lower, but it's not quite as bad as it sounds. I will say, though, that leaves us in a place where, as more people start to look at these things, I do think it is a point of vulnerability. Okay, so having said that, I would like to then move on from the broad market, knowing that we've got earnings coming up and knowing that we have the election coming up. I don't know that the election necessarily is something we're going to talk about here and now, but the largest publicly traded equity in the land is, of course, Apple. And Apple shares just hit a new all-time high last week. But as I look at it, I think that there are some things that could also potentially weigh on the returns for Apple going through their earnings, which they're expected to report on October 31st. So first of all, I'd like to talk a little bit about the things that are very good about Apple, right? So they control 60% of the US smartphone market. And while they don't enjoy quite as dominant a position internationally, Android devices predominate internationally, they still are more profitable internationally than any other smartphone manufacturer. How is that possible? Well, Android devices, of course, are made by multiple manufacturers. The largest of those is Samsung. And Apple's earnings are multiples larger than Samsung's is. And most of Apple's revenues and most of Apple's earnings come from the iPhone, more than 50%. Actually, let's just take a quick peek at that. Of course, Samsung is in a lot of different businesses, but just to give you some perspective, we can take a look at the segments here. I just have to blow up the products and you can see this for yourself. So the iPhone has pretty consistently represented in the low 50s in terms of the company's revenue. That only tells part of the story, though, of course, because their services income related to payments and iTunes and things like that are obviously hinged to it in another way, which is that people get involved in the ecosystem, and that's all a big positive. So, premium product, most people who've been surveyed, who switch from Android to Apple, say that it is a better device, it is a better operating system, it is more premium, but they charge a premium price. And here's where we get into a little bit of trouble. So they just released the iPhone 16 a month ago, much touted because it's going to have AI features. I actually thought that one of the reasons that we might get into a refresh super cycle was because, and this was due to international regulation, they were going to change the charge port from the proprietary Lightning port that my iPhone has, and most of you, statistically, it's more likely that you guys carry iPhones in the United States than any other, that switching to a USB-C was kind of a popular idea. Nobody wants to have all of these proprietary things. So it is possible that people who knew that would have been holding off on upgrading their phone until they were going to, because that sort of affects your ecosystem, your universe as well, your chargers, what you have in your car and all the rest of it. For those that are using plug-in chargers, as well as maybe you have a charging pad. My car has a charging pad, but I often use a charger. Everybody in the household carries iPhones. So I thought that might prompt a refresh supercycle. People would say, okay, now's the time. If I was holding off, now's the time. We are seeing analysts reduce their estimates for iPhone 16 units. And while it does appear to be selling well, it may not be that refresh supercycle that some had hoped it might be. Okay, so that's a downside. What's another downside? Another downside, and as I often say, the fundamentals are not a timing tool. And somebody was just telling me iPhone 15s had USB-Cs. If that's true, that's it. I did not think they all had. I didn't think they all had USB-Cs universally. I will tell you that is actually one of the reasons that I didn't make the switch myself at that time, was because I was waiting for it. So shows what the heck I know. I needed to ask the kids about that. So that's another knock on it, if that's the case. Okay, so now we're taking a look at the price to earnings, and I'm going to actually just throw the forward price to earnings multiples up here. And we'll go back for, call it 7 years or something like this. And here too, you can see that we're not as high as we've ever been, but we are at above average levels, right? Now, we'll also remember that there was a period where this thing was absurdly cheap. You can see back here when the thing was trading 10 times earnings. That was just ridiculous. And it was even more ridiculous when one considers that for a period of that time, the company was, more than 30% cash. So if you extracted cash, it was even cheaper. But here's the reality of earnings growth right now. I'm just going to go like this. And we can see that, obviously we had a little bit of a lull. We had that 2021 spike. People had a lot of money in their pockets. There were a lot of transfer payments that helped encourage consumers, but that's over and done. And now what we're looking at is 2022, much slower growth, and then last year, full year, ending September 30th, we actually had negative year-on-year top-line growth. That's not even inflation adjusted. So that's obviously a negative. And then one final point, too. This, it may or may not have an impact in the short term, but they are being sued by the government right now for antitrust. Now, this isn't new news. This is not a revelation that I'm dropping on all of you. That happened back in March. Also, we have an administration right now that seems to be pretty aggressively turning over rocks where they believe there may be antitrust concerns. Any business that is dominant in their space is getting looked at. Some are just being looked at. Others actually, like Apple, are contending with and needing to try to file to dismiss. But the fact is that these types of things can weigh on a company for some time. And like I said, it's not unique. There was an article out, I think it was last week, that said that the current administration is investigating 40% of the S&P 500 by market capitalization right now, the FTC. So we have an aggressive administration, but these are things that could potentially weigh on. High multiple, maybe not getting the super cycle that we expected or wanted out of the AI-powered iPhone 16. Government involvement, all of these things cumulatively could put a lid on it. So what to do? This is one of the arguably the most broadly held security. So if you happen to own it, there's a good chance that you do. One of the things that you could consider, and this is particularly true because, look, if you're a long-term holder, we're coming up on the end of the year. It may not be all that appealing to contemplate selling it and taking a capital gain. Maybe not this year, not next year. Maybe it's just a long-term hold. And, I want to say this is going to remain one of the more profitable companies for a long time. I'm not saying that Apple's going to pull a BlackBerry on us, because there's nothing really on the horizon that suggests that. Their position is a very different one than the one that BlackBerry occupied at the time that the iPhone came along. But it does suggest that it will be harder to see really large gains. And consequently, one final thing. I apologize for going backwards before I get to the options strategy. And that is that, one of the things that people always talk about in companies like this is, well, what about the buyback? The buyback, that's going to create support for the shares. And on a nominal basis, of course, their buyback, the most recently authorized one, which I think goes back to May, is enormous by almost any other company's measure, $110 billion. So huge, right? Except that the company is worth about $3.6 trillion. So the buyback, big as it is, and I'm not meaning to dismiss it, it's obviously very, very large, but as a percentage of the company's outstanding shares, it's not as meaningful as it once was. There was a time when you were looking at the company buyback didn't need to be anywhere near that large when it was a $500 billion company, and you could get a much more meaningful percentage of the shares being repurchased. And let's not forget, Warren Buffett. I mean, he dismissed it early, then he got on the Apple train, and then more recently he's reduced his positions quite significantly. So there it is. So you have the stock. What do you do? And you don't want to sell it, right? So you can think about hedging it. I think I'm just going to use November regular way as an example here. And the reason I'm going to do that is because that obviously captures the October 31st earnings, and it captures the election and all that kind of stuff. So what you would do is potentially, because we don't think it's going to be a complete, we're not making a huge bearish bet here, just trying to find a way to mute a downside move over the course of the next month or so without really spending any money. And one way to do that is with a put spread collar. So you buy a put spread and you finance that in part by selling an upside call. And I'm just going to use the 230 puts to purchase here, and maybe we'll sell the, let's go like this, sell the 250 calls, and then sell some lower strike puts against it. All right. So this is what that would look like. So what you can see here is that, and this is evaluating, this chart that you see is evaluating only the performance of the hedge, not the performance of the hedge with the stock added. But you can see that effectively you get a little bit more upside, then you start to see some profits to the downside on this trade. But the standalone cost is effectively zero. So you'll often hear people talk about a zero cost collar, buying downside puts, selling upside calls for no net premium. It is usually the case that if you set a trade like that up because of put skew, that is to say that the puts trade at a higher implied volatility than the upside calls, you usually are going to find that you get, against a long stock position, an asymmetric payoff in that case, which is to say that you have more downside risk than you have upside participation in that case. Now, so that we can just see how it behaves with the stock, I'm going to add the stock to it, again, to illustrate. And so here's what you actually get. So you have participation to the upside, which is capped. And then to the downside, you can see you have some immediate downside risk, which makes sense because we bought the 230 put, the stock's trading 236.48. So, you have downside risk down to that 230 strike that you bought. And then you are going to get a little bit of a bump provided by this downside put spread. Now, is this better than simply doing a straight zero-cost collar? Well, that's going to depend a little bit on what your thesis is. But we're not suggesting that Apple's going to have some kind of catastrophic wipeout. There's not that much that we don't know about what could happen with Apple here. There's a lot of channel checks, right? People are paying attention to Apple manufacturing activity. They're paying attention to unit sales. The other thing is that even if the news was bad with the iPhone 16, it's arguable or possible that some people are looking towards the holiday season. Perhaps people want to give this thing as a gift, popular gift, right? So it is also possible that people are going to start looking further out through that. And so the objective in using a put spread collar is to mute the impact of a downside move, but you're not hedging against some kind of a horrific blowout. Okay? So just, something to think about there. What if you don't own Apple, though? And you were thinking about buying it ahead of this, and now the things I've told you have you a little bit alarmed. I could add something else that could be a little bit alarming if one wants, and that is to say that I think 26% of iPhones sold are in China. And I don't know necessarily that anything that's going on is going to impact Chinese demand that I can see. But one thing we can see is that with respect to the election, that there's been quite a lot of rhetoric about Chinese imports and tariffs. And they depend heavily on China, not just for sales, but obviously for manufacturing too. And so another potential risk, another potential reason to try to get to sort of capture the election one way or the other. Certainly one candidate has talked about concerns and Chinese tariffs more than the other. So if you were thinking about wanting to have some upside exposure, but reducing that risk a little bit, a calendar spread might be a better way to go about doing that. Just looking for a little bit of and because I was already using November, I might as well. But in that case, you would buy an upside call, longer dated, and then arguably sell it into a diagonal, something like this. I favor diagonals because I would never want to take a directional bet to the upside and be so right I was wrong. What I mean by that is you're making a measured but bullish bet going into earnings. You don't want to have it go in your chosen direction and still lose. By the way, you will observe as you look at this that you're getting some upside and then it's capped, which is not totally dissimilar to this. You can actually achieve a P&L that's closer to that by selecting a higher strike to the upside, maybe something like the 252.5s. And if you were going to get that sort of downside exposure, a willingness to purchase the stock at a lower level, you could actually achieve that by then turning it into a risk reversal of sorts by selling a downside put. I'm not necessarily advocating this, but I just want to show how you can create similar payoffs, with strategies of different constructions. So trying to mute the exposure, have some upside, willing to cap it, being willing to own the stock at arguably a lower level. This is another mechanism that kind of achieves that. And you'll see that it's not exactly the same, but it has characteristics that are vaguely similar. The objective here, of course, is going to also be to take advantage of some of that vol crush. Okay, and I think somebody was asking me in the chat whether we could talk about earnings. So there you go. We've just discussed it. There's one. Finwest says, "Good morning, Mike. Another earnings week in store. I'm selecting my targets: Lockheed Martin, Tesla, IBM, and UPS." So Lockheed, it hardly seems like we live in a universe right now where you'd want to sell defense stocks. sad to say. I don't know that it's ever time to sell them. We just seem to be a world that loves war, and therefore the companies that make the tools of war will always find a market. And so it is with Lockheed. And interestingly, of course, Lockheed, unlike Boeing, which is another defense contractor, it doesn't seem to have the same kind of operational problems. Tesla. So we saw a big contract. If some of you didn't see this last week, because I highlighted this, we saw a huge call spread in Tesla trade last week, and it was the 232, 252.5. One of the prints was a 31,500 lot, but there were a couple other institutional blocks that took place on or around the same time. And that was actually a very targeted trade because they were looking specifically to the end of this week. So it was just the October 18th regular way options, and 25th. 18th was last week. 25th. So they were capturing earnings, and they were buying the 232.5 calls, and they were selling the 252.5s. So what's interesting about these strikes, so that's what that trade looks like right there. Except they weren't trading a one lot, which would cost you $222. They traded something like 33,000 of them. So chunky, shall we say. So here's what's interesting. Right, and we'll see where this is priced right now. Tesla options were, to my eye at least, quite cheap going into the print. So this is a company that has moved, I think, on average, the week that they've reported over the last 8 quarters, an average of about 13.5%. And we can actually take a look right now. We'll just use the 217.5s. So what do we have here? 835. I mean, we'll just call it 830. I don't know if we have to choose the offer necessarily. We could, I suppose, but we'll try to pick some midpoint-ish value. So give or take $15 by the end of the week. So that's less than 7% implied move, mean absolute deviation, by the end of the week. Now, of course, we've just had Monday trade, so we're only looking at 4 trading days. That's one less than the average that I had historically looked at. But that's low. And if you take a look at the 232.5 to 52.5 call spread, based on where the stock was trading at the time, around 220, 221, that was a call spread that targets a move of between, 6.7, 6.8% and 14+% to the upside. That's where the upside would be capped. So if you have an average move of 13.5%, that's going to capture it. Now, granted, a move of 13.5% from today's price, which is a little bit lower, so that gets you to an upside of 248.56, right? That would be up 13.5% from today's close in round numbers. If it got to that level, that call spread is going to be worth the difference, 248.5 less 232.5, so you're looking at $16 is what that thing's going to be worth, and it costs you $220 as of today's closing prices. So call it $225. We'll factor in commissions. So $13.75 over $225. That's a payoff of 6 to 1. So I think, as far as Tesla is concerned, if you're inclined to make a bullish bet, the options market is not implying that it's going to go higher. I would actually generally say that it feels as if it feels heavy to me. And it's not a cheap stock. It's a Holly Index name. Love the products. Love what they're doing over there. And it's not just me saying it. So here we're just going to take a look at all of the technical indicators. You ignore buy and hold, as I often say. We've got 22 technical indicators here. 5. Only 5 of them are bullish. All the rest are bearish. But, you know, if you're inclined to make a bullish bet, that call spread might not be a bad way to do it because it pays 6 to 1. So the odds aren't in your favor, but it's, you're not playing the favorite. And that's something to think about. Okay, so IBM, I don't really have a lot of feelings about IBM, I have to say, although they seem to have firmed things up. UPS, I mean, we got some good results out of FedEx, or reasonably good in one of their recent earnings reports. Yeah, back in that June, July, they gave all of that back on the subsequent one. And we are entering that period where I personally have gotten shellacked on FedEx. But, look, these are companies that continue to have some secular tailwinds. UPS, I would say, so, historically going into the holidays, UPS appeared to have more operational logistical challenges and problems than FedEx did. And I know in recent years, they've really endeavored to try to improve that. But that's obviously a potential risk. So we'll take a look at the technicals on UPS here. And again, not my technicals. We're just and it looks like those are, well, ignoring this one, a little better than 50-50, obviously. And let's see what we have here. And then we're just going to eyeball it relative to the 150. That doesn't look too great to my eye, but we're bumping right up against it. So that could be, I think that's the level that you're looking for. That's the number that you're trying to break out of. But that doesn't look too great to me. Give me a great cause to celebrate. So I'm curious, FinWest, whether you were thinking about this one on the long side or the short side, or you were just wondering. Because that looks like a downtrend to me. We can take a quick peek at the multiples on a historical basis. How are we doing there? It's obviously cheaper than the market, but that's actually been true for some of these companies. I also will say we saw a real bifurcation in the transports last week. We had the airlines, many of which were very cheap and arguably had just gotten too cheap. And then we saw a lot of trucking companies. I think I was looking at J.B. Hunt and a couple others. And these things were, trading around 30 times earnings. And the airlines, United is probably the best example, trading around 5.5 times. Obviously got a huge pop, which I'm sure you guys saw. I think we actually referenced that. But even net of this pop, it's now, I think, trading, about 7.5 times? I'm just doing that in the sort of back of my head. What do we got here? Not too bad, right? So full year earnings, $10 a share, estimated on $74. So I said 7.5 at 7.4. But some of these other transports, I'm a little less enthusiastic about it. They're not that cheap. The truckers certainly aren't cheap. FedEx and UPS are cheaper than the broad market, but they're cyclical. And I don't know, that chart didn't look so great to me, but maybe there's a setup. Maybe we can find a decent setup. Let's see. Bullish. Okay. Got its act together. Got to do better this time, so I'm bullish. Um, Got to do better this time. I'll just tell you a little bit of maybe it's not that funny a story. But back in the late 1990s, when I was a floor options trader on the American Stock Exchange, and I traded, among other things, Philip Morris. And nearby crowds to the Philip Morris crowd was Telebras and AT&T. Or actually, excuse me, Lucent. It wasn't AT&T, it was Lucent. And Lucent was the former Bell Labs. So for a long time, this was thought of as basically the corporate brain trust of America. People thought that the smartest engineers and all this great stuff was going on over there. And now that the company was no longer a monopoly and they'd split the whole thing up, and so you had AT&T and you had Lucent, they really thought that unshackled, this thing was going to just take off. And I remember that Lucent, would report a disappointing quarter, and I was not one of my products, but I was just listening to the traders who are in the pit right next to me, and we would see these options bets come in, and the stock was basically just trading from the upper left to the lower right, and you'd see these bullish bets almost every quarter because there was this narrative that this company was a great company and it just had to figure out its way in the world. And one of the things that commonly was said was, oh, they disappointed on the last earnings, so they definitely won't this time. And of course they would. And they would again, and they would again. And one of the things that began to occur to me was, it's an interesting thing for investors to believe that because a company had a bad result, it's definitely true. Management knows that if they keep coming in quarter after quarter and giving bad news, that they may not have a career forever. But that doesn't change the reality of whether they're doing a good job or not, or whether the company's products and services are in demand or not, or whether there are secular headwinds or tailwinds. That's unaffected by the fact that management doesn't, would like to try to deliver good results. And it's not that easy to turn things around. As I think it was Vince Lombardi that said, winning is a habit. Unfortunately, so is losing. And so it was with Lucent. And so it can be with these companies too. And that is because some businesses are just hard. If you're NVIDIA and you're the only game in town for the products you sell and people will pay any price and take you out to dinner and beg you to sell them your product at a 70% gross margin, that's the opposite situation. But this is not the case for FedEx and UPS. And by the way, I often talk about the secular tailwinds that these companies have, but don't forget, they are facing competition from part of that secular tailwind. And who am I referring to? Amazon. When I look around here, sure, I see UPS trucks and I see FedEx trucks, but I'm seeing lots of Amazon vans as well. Now, the Amazon van situation, it's a little bit different because if you don't know, they run these they're like franchises. So when you see Amazon vans running around your neighborhood, those aren't necessarily owned by Amazon. They're often subcontracted local operators in the logistics business that have a contract with Amazon. So they have those vans and they make the deliveries and all the rest of it. It doesn't mean that they're owned by Amazon, the company. But my point is actually just to say that it is not a strict duopoly for FedEx and UPS anymore. So just something to think about there. So if you're going to go into UPS earnings and you're going to bet it on the long side, let's just take a look at how you might do that. First things first, let's just take a look at how the options are priced relative to how much the stock has moved. And we can see these recent results right here. So we can also see that only 2 of the last 8, 2 of the last, 10 were positive results. So we can certainly see FinWest that, yeah, the last quarter probably was not so great. What's interesting about this is that the implied one-day move being 4.9%, at least according to Bloomberg. Let's verify that. So the straddle 131. So everybody who's trying to pay attention at home, we're just doing the back of the napkin way to calculate the implied move, which is taking the at-the-money straddle that expires at the end of this week. We'll call it 370, and, you know, I'm going to pick a number in the middle. We'll call it 415, 785 over 131.33. So that's actually 6% by week's end. So now I'm just going to take a look and say, okay, I'm going to change the time frame that I'm looking at. So do they report pre-open, or I think they report pre-open. So I'm going to make that into a 2 minus 2 plus 2. So that average is closer to 5.65%. And over the last several quarters, we can see it's actually probably even bigger than that, but we've had several double-digit numbers in the mix there. And in fact, we're just going to do this. So I just dropped that into an Excel sheet. We're going to see what it was over the last 4 quarters and the last 8. So the last 4 quarters, the average was 8.5%. Over the last 8 quarters, it was 6.8%, which is spot on what the market's implying. So options are very fairly priced if we think this is going to be a move of similar magnitude. You want to make a bet to the upside. You know, I think something like that call spread, same thing that we saw done in Tesla, probably makes sense, because like I say, the options are reasonably priced here. My own sort of not overwhelmingly positive view on the company notwithstanding. So we could choose, you know, I usually like 30 delta options or 30 delta trades, but let's just take a look here. We can go, where's that one standard deviation move? So 1, 2, do something like that. Okay. So you could look at like a 132, 142 call spread, something like that. Little bit more than 25% of the distance between the strikes to get that off, but that would be a way to play it if you have interest. Okay. So Steve Garcia says there was unusual options activity in CVS. 5,800 of the no 50 calls. Open interest is just 100. These are 90 delta calls and short dated. Do you think these are long positions? Let's take a look at that trade. So first of all, that's, oops, got to type it right. These companies, by the way, are a disaster. CVS and Walgreens. I mean, they just cannot seem to figure this stuff out at all. So 90 delta calls, short dated. Do I think these are long positions? I'll tell you, first things first, I don't think that it really matters. But my guess is that it's a conversion. And let's just take a quick peek here. Yep. So it's the no 50 calls. I'll bet you that's against those no 50 puts. And there's probably a block of stock that traded around the same time. Let's see. Let's see. There it is. Yep. So they traded the 50 calls, the 50 puts, and now that was at 10:56:02. Let's see how good the traders were at putting the print on the tape appropriately. So we are looking for a trade of 500,000 shares. 583,000. 500,000? How many was that? Yeah. How many contracts? Yeah, so 500,000 plus. So 1056-ish. There it is. 583,000 shares of stock. Okay, so what happened here? Somebody reversed, somebody converted. They are trading the common versus the synthetic. So one side is to buy stock, sell call, buy put. And the other side is to sell put, sell stock, buy call. One of the reasons there's a couple reasons why people will do a trade like this. One is to essentially flatten out their sheets on a net stock basis. So if they're a market maker and they're carrying a lot of stock, maybe that has an overnight interest rate expense for them. That could be a reason to do it. If you are betting that a company is going to become hard to borrow, or you want to be able to hit downticks, then you want to be converted. So you're carrying long stock as a market maker. It was actually the most common thing we would do when we picked up a new position. I remember when Tyco multiple listed, Halliburton multiple listed, we got the listing on the specialist post. Very first thing we did in those listed names was to convert for good size. Just make sure that we had 1 million shares or so to sell, because we didn't want to have to get into a situation, and there was not an exemption at that time. If somebody came in to buy puts or sold you calls, so you had to sell stock to hedge, there was an uptick rule, right? And so we do periodically get uptick rules here too. We had Jim Seligman on from Strategic Price Improvement. It's kind of their area of expertise, but we're not seeing it here. But when you see a little S over here, what that indicates is that you need upticks to hit the stock. And if somebody wants to be able to hit downticks, but they're not necessarily looking for overt exposure to the stock, otherwise you can convert. You buy the stock, you sell the synthetic, and you basically are financing that position, and you have stock to sell. So in this case, whoever did this, one side converted and the other side reversed. And it is possible that the side that reversed already had the stock. So simply by getting paid to reverse, they could just sort of be reducing their balance sheet. So those no 50 calls, a directional bet's not the way to think about it. But if I was going to think about it as a directional bet, I would be more likely to believe that it is somebody who wants to be converted. And the reason to do that, absent a situation where stock is hard to borrow, and if it was really hard to borrow, you wouldn't actually, or you were anticipating that it would become so, you wouldn't actually be trading into a strike that's so far below the money. And the reason for that is that if it became impossible to borrow, your short call they could call away from you, right? So you wouldn't choose a strike that was deep on the downside that way if you believed it was going to go impossible to borrow. So that's not the bet. So just by looking at these prints, there's a couple takeaways we can just figure out pretty quickly. But my guess is that's somebody who wants to be able to hit, doesn't want to be subject to an uptick rule if that becomes a situation. So I have a feeling that's what that is. So I wouldn't view it as a bullish thing at all. So I hope that helps you. Palantir. Okay. So let's take a. Oh, did I skip over? Oh, I've just been advised I accidentally skipped over some questions. So Tom N just said, before I get to that, Tesla earnings sure to produce some fireworks. So it's interesting because the options market is implying less fireworks than usual, but I actually think, to your point, that is a good setup for people who want to play it directionally, because the options are very reasonably priced. Whether you're making a bullish bet or a bearish one, I think it's very reasonably priced to do so with options right now. They're about as cheap as they have been. Steve Garcia, I conceptually have trouble understanding fixed strike vol. What additional or different info do you get from this versus just looking at changes in the VIX. Yeah, so this is slightly deep end of the pool stuff that we're going to get into, but I think I can illustrate it. And so let's just talk a little bit. I'm just going to quick summary. What is the VIX? The VIX is a measure of implied volatility in SPX options. Okay, 30-day options. It's always looking 30 days out. And the way they do that calculation is they create a synthetic strip. So I think I've discussed this in previous live streams, but the higher a strike is, all else equal. So same moneyness, meaning that relative to where the stock is. But all else equal, a higher strike, a higher number is going to have a higher vega. So that strip basically is weighted. So that you get something that looks like flat vega. They create essentially the functional equivalent of a synthetic variance swap. All of this is, I realize it sounds kind of complicated. There's actually a very detailed web page on the SIBO's website that describes their methodology. So for anybody who wants to get into it more deeply, you can go there, and I don't really need to get into it too much to do this. So we're going to choose some 1 month options here on 2 different dates. And maybe we'll spread these out a little bit. Okay, there we go. Now, if you look at the bottom of my screen, these are all individual strikes. So both of these 2 charts, the white one and the red one, are the implied volatility for options at these strikes on the respective days. And these are, I've chosen days that are 1 month apart. Okay? And so the white one is current, and the red one is 1 month ago. Now, you're going to notice a couple things. So one is that implied volatility is higher now, and the VIX is higher. But there's something else that is related to Steve's question, and that is that you're going to notice that these are both lines that have a negative slope. They have negative skew, as we call it. The downside put strikes, so these are lower strikes as we move left, higher strikes as we move right. The downside puts have higher implied volatility than the upside ones. The reasons fundamentally why that might be so are less important to his question. What is important to think about, though, and so I'm going to introduce one additional 1 month implied volatility in here, and I'm just going to go back. We're going to go one day back, so 1 business day ago. There we go. Okay. So we know that the market was lower today, and we know that implied volatility was higher. What happens is that when you calculate that strip, it's choosing a whole strip of options, and as the market moves down, that strip is going to move down as well. Why is that? Because they only take options for which there's a positive bid. The first 2 option strikes that have no bid, they discount everything above that. And the first 2 put strikes that have no bid to the downside, they discount everything below that. So you have this strip of options that slides up and down based on the level of the underlying index. As the market goes higher, the options that are being evaluated, the strikes go higher. And you can see that those higher strikes have what? Lower implied volatilities. So there's 2 things that are moving that affect the VIX. One is spot. As the spot price rises, you're going to higher strikes that have lower vols, all else equal. As it falls, you're going to higher vols, lower strikes, all else equal. And it is one of the reasons why from one day to the next, you always see that, or you often see, that the VIX will rise when the market falls and the opposite. So there's this anti-correlation, and that anti-correlation, I actually, just in the back of my mind, I just sort of think, okay, I expect to see the VIX move about, it's almost a delta -1. So 1% move in the S&P, 1% move in the VIX, all else equal. Now, of course, on a fixed strike basis, vols can also shift higher and lower. And that's what you're looking at right here, right? So we can see that this 59.10 strike call was 13 spot 40 vol on Friday, and it's 14 spot 08 vol today. So the VIX is rising for two reasons, because the implied volatilities of individual options has risen slightly, but also because the options that we're looking at are now lower strikes, and the lower strikes have higher vols than the higher ones do. So that's really all. When people, and I'm actually curious, I mean, you guys probably, I actually highly doubt that very few people who are going to talk to you about implied volatility are going to do it on a fixed strike basis. I mean, that's really inside baseball kind of stuff. So I'm going to expect that you don't get it that much, that people are talking about that. But why does it matter to you when you trade options? Let's imagine that you bought a call option in SPX. So on Friday, you bought a 4-week call option in SPX that was, call it, 2.5% out of the money, betting that the market rally would continue through the election. And today, the market goes down, and your logic was that if the market goes up, I'll win on delta. The market's rising, so it's moving in my direction. If the market falls, implied volatility will rise, and that will mute the downside that I have. There's some truth to this, of course, but maybe not as much truth as the VIX would have you believe. And the reason is because the VIX is going higher for both reasons. Because vol's going slightly higher on a strike-by-strike basis, and it's going higher because they're looking at lower strikes, which themselves, because of skew, have higher vols. So that's the only reason why I think for most retail investors you need to contemplate this. If you are a vol trader, when we were trading vol, we cared a lot about this because we were always really trying to think about how much the implied volatility of actual options we held changed as a function of time and a function of spot. But from your perspective, just know that you have both of those dynamics working. Those are both going to sort of happen. Okay, so that's, this is fixed. The picture you have there on that screen, that's fixed strike at different times and that kind of stuff. Thank you for the explanation. I'll have to re-listen to it several times. Just go. Like I said, SIBO they have a methodology on if you're interested in the VIX calculation, just go there, because they just give it to you. They give you the whole formula, and you can put it into an Excel sheet if that's your thing, and do it. We used to, do that on a modeling basis so that we could trade futures, S&P futures versus VIX. But it's just useful to have an intuition for how options prices move, and where you get a little bit of perception and deception kind of stuff going on. Here we are. EWBC, what do you think of a we're going to build this trade really quickly, and I recognize that I've taken up more than an hour, so I'm not going to take a whole lot more time. Where's my options place so I can build this out? We're going to get to the open interest portion of that question in just a second, but you have a specific trade. What do you think of a Jan 85.90 100 call spread risk reversal? Okay, so generally speaking, these are strategies that I kind of like. You did you specify? Oh, Jan, yes. Okay, you did specify. So we're just going to go out to Jan. And so when you trade an 85.90 100 call spread risk, that means that you're probably selling the 85 puts. You are going to buy the 90 call, and you are going to sell the par calls. And actually, we're going to look at this two ways. So you can look at this as, this is kind of similar to what we were looking at before. You're going to notice that a call spread risk reversal, does that payoff shape look familiar to anybody? It's going to look really similar to the payoff for a long equity position hedged with a put spread collar. So long stock put spread collar is functionally equivalent to a call spread risk reversal. And we like these trades generally in situations where we think that the options are at least fairly priced or maybe slightly overpriced, because what it gives us is upside participation with less downside participation within a range, right? So an asymmetric payoff, if you will. Think about it this way, right? So we look at the P&L at 80 bucks. So this thing was trading 90. So if it goes down 10 bucks, I mean, this is round numbers, it's really 89, but it goes down to 80 bucks, you're going to lose $370 on this structure, give or take. And if it goes up to 100, you're going to make 1,100, right? So on a $10 move, a $9 move, 10% move, right? So on a 10% move in either direction, one side of that's going to give you almost 3 times the P&L that the loss on the other side would provide. And that sounds like a no-brainer. It's not quite a no-brainer because, of course, your gains are capped to the upside, whereas to the downside, obviously you could ride the stock all the way into zero, right? And then you're going to collect a little bit of premium, about $1 a share. So if East West Bancorp goes to zero by January expiration, I'm not saying there's any high likelihood of that. It's a very low likelihood event. But what I'm saying is that the real downside risk in that case is going to be the strike that you sold, 85 less the premium you collected, or plus the premium you spent. In this case, less the premium you collected. So your risk is $84 a share, round numbers, right? But yeah, I like that as a strategy. And also, let's take a look at something else. So if you're looking at this chart, notice the levels that you've chosen, right? Right, it was basically range bound in here between 78 and 83-ish. You're going to, that's essentially where you're trying to get protection to. And that makes some sense to me. So I like that trade. Okay, and my battery's running out on my little monitor here. So with that, I'm going to have to call it a day for this live stream, but we're going to be doing another one on Wednesday at 4:15. And I owe you... Oh, yeah, and actually part of that question was that open interest was non-existent. Just make sure to use a limit order in the complex order book. That thing should trade at a credit of about $1 if you're going to do that trade. Or at the worst case, if you're not getting any traction doing that, trade the call spread piece as one bit, and then you can work the put independently if that's a problem. But for retail trades, especially if you're interested in wearing the position pretty much into expiration, I wouldn't worry about it too much. If you're trying to do something really big, so if you're an institutional trader, then you can obviously call and ask someone to facilitate it, get some cap commitment. I would have made a market on that, and I'm sure there are many who would. So, but then you have to deal with an upstairs broker. But chances are that's not what you're talking about here. So use the complex order book, work a limit, marketable limit order, and it should be fine. And I owe you guys an answer on Palantir, and I will address that on the next one. So I have to make a note of that. Let's just make sure I'm not. And we have time. Okay, so Palantir is not going to be announcing earnings until November 4th. So we have time to get to that. All of you guys who tuned in, because this was a little bit of a ramble. I wasn't going to talk about that JP Morgan, Goldman Sachs, Case Shiller stuff. Actually, I shouldn't say Case Shiller. So it's the cyclically adjusted PE. The Case Shiller thing is more of a real estate thing. But it was kind of an interesting thing, and somebody addressed it right before the live stream began. I thought, you know what? We should probably talk about that. But we'll talk about some other stuff. Palantir, among them, on Wednesday. And I look forward to seeing you here. Thanks for watching.